Hello guys, we are going to discuss study unit 18. Please let me tell you. So unit number 17 plus unit number 18. These two units are called internal control section. Okay. So and these two chapters are 15% of your exam. So please note we are discussing unit 18. In unit 18, we have three main topics. Topic number 18.1 is about control procedures. 18.2 is about system controls and information security. And topic number 18.3 is about security measures and business continuity planning. So we are discussing 18.1. In 18.1, we have two main sections. One, we have types of control, which we have discussed in the last class. And there is another part of 18.2 that is called accounting cycles. Okay, accounting cycles. So today I'm going to cover accounting cycles. So there are 5 accounting cycles are there, and these cycles are really important. So they will ask many questions in your exam. So those cycles I'm going to cover today. Accounting cycles. Here we go. So accounting cycles we are going to discuss, guys. There are 5 accounting cycles because these cycles we need to know because it is relevant to the internal controls. Okay. So what are internal controls? If you don't have idea, I can quickly tell you. Internal controls mean to say these are the actions taken by management to mitigate the risk. For example, we install the cameras. It is also internal controls. We need dual signature on a check. It's also internal control. We always keep our cash in the lock system. This is also internal control, right? Juniors work is checked by the senior or the supervisor. It is also internal controls. We are using computer generated invoices. The sequential number of the invoices is also internal controls, right or wrong? So we are doing sometime reconciliation. For example, we are reconciling our physical inventory with the inventory which is recorded in the system. That is also called internal controls. But our topic is accounting cycle because cycles we need to understand because it has relevance with the internal controls. And there are in total 5 accounting cycles are there. 5 cycles. Okay, so we need to understand these 5 cycles. Cycle number 1 is called sales to customer on credit and recognition of receivable. So it is also called sales to receivable cycle. Okay, because obviously when we sell the item from that point till the recognition of receivable in our accounting system. So this is called sales receivable cycle. Then we have a second cycle, which is called collection of cash from customers receivable. Obviously, when we sell goods to the customer, in future, we will collect the money from the customer. So there is also cycle for cash collection. That is why second cycle is also called cash collection cycle. Third cycle we have here, purchases on credit and recognition of payable. Obviously, when we purchase goods on credit, we have to book the payable. So that is why from the point of purchases till the booking of payable, what is the purchase payable cycle? So that we also need to understand. Then we have a fourth cycle that is called payment or disbursement of cash to satisfy trade payables. Obviously, against the credit purchases in future, we will also make the payment. So that is called payment cycle. Then the fifth cycle, which we need to understand, that is called payment of employees for work performed and allocation of cost. It is also called payroll or payroll cycle, you can also say. Okay, because it is payments to employees, right? So these cycles we are going to understand. So here we go. First cycle we need to understand, guys, and I'm going to explain it now. So what you have to do, you have to simply memorize the steps in each cycle, because mostly in your exam question, he will ask you, for example, in sales cycle, what will be the first step, what will be the second step. He will give you 4 options, right? Or no, you have to collect. Or maybe in one option, he will write the steps in a sequence. Okay, and in some options he will write some steps in incorrect sequence. So he will ask you what is the correct sequence of the activities. So you need to understand, and sometimes they will also ask you why we apply this step for which control purpose. So control you also need to understand. So here we go, guys. Starting from sales receivable cycle. It is called sales receivable cycle. So we are going to understand now. I need your concentration. So primarily, so you can see there are 2 main columns are there. One column is for business activity, and second column is for embedded control. Business activity means what steps you are taking and what is the control for that step. So that both you need to memorize. But initially, you have to memorize this column for steps. Once you will know the steps, automatically you can understand the embedded control of that step. So here we go. Don't forget, we are discussing sales receivable cycle. It is too much theoretical information. So that is why I will explain it slowly. So you need to understand, please. Okay. So we need to read step by step and I'll explain, and you have to remember in each step, this step is performed by which department and which document is created for by that department. Okay. You need to understand. So first step, if you will read it here, it's written sales receives a customer order. First understand here sales means a sales department. Sales department will receive a customer order. Okay, customer order. Obviously, from customer point of view, you will think it is the purchase order because customer want to buy a goods from you, right? So sale department will receive a customer order. Understood? And what customer want to buy? Obviously, some goods he want to buy. And sales department will prepare a sales order. Okay, who will prepare the sale order? Sale department. For example, if you are a sale department, you receive the order from the customer. Now in your department, you will prepare a sale order and you will forward this sale order to the credit department, which is also called credit control department. Understood? Then this is the first stage. Second stage is what? Credit. Now, credit department we are talking about. Credit department performs a credit check. What does mean by credit check? He will check the credit worthiness of the customer, that this customer is credit worthy or not. Like this customer will pay you in the future or not. How many chances there are? How many chances for the bad debts, right? So obviously you will not make sales to any specific person who might result in bad debts in future, right? So that is why credit will always perform credit checks on the customer. Okay. If customer is credit worthy, then credit department will approve the sales order. Please remember the role of sale department is to prepare sale order which was sent to the credit department. Credit department will perform the credit check on the customer, and if customer is credit worthy, credit department will approve the sale order. Understood? Okay, here we also need to understand when sale department prepares the sale order. Why they prepare the sale order? This is the control for that. Because they want to record, or it means it's a reconciling sequentially numbered sales order helps to ensure that orders are legitimate. Obviously, because sales orders are computer generated, you will generate on the computer and it will have some number on the sale order. So this number you can verify from the system to ensure this order was legitimate. Then once the credit will approve the sale order, okay, once the credit will approve the sale order, so what is the embedded control here? Actually, credit department is trying to ensure that goods are shipped only to the actual customer and that the account is unlikely to become a delinquent. As I told you, credit department performs the credit check on the customer just to ensure that it would not result in the bad debts. Okay. Step number 3. Step number 3 is what? Credit. Because credit department approves the sale order. Now here, please remember, credit department will make 5 copies of approved sale order. Okay, this is what it's written here. Credit sends the approved sale order to 5 departments. Which department? One, it will go back to the sales department. Okay, sales department. One copy will go to the warehouse and one copy will go to the shipping department. One copy will go to the billing department. Okay, and one copy will go to the inventory controller. Now, what is the purpose? This purpose we are going to discuss now. Okay, because here, what is the control? So, credit department is trying to notify these department that a legitimate sale has been made or sale order has been approved. Okay, another reason, I'm going to explain the reasons now. Why we send one copy to the sale department first. Then why we send one copy to the warehouse, to shipping, billing, and inventory control. So here we go, we are discussing now. Once the sales, because one copy was sent to the sale department. So here I'm explaining now sales department. Once sales department will receive the approved sale order, so sale department would send an acknowledgement to the customer. Acknowledgement, like you can acknowledge through the email that your order is in the process and soon you will receive the goods. Understood? So that is why we send the approved one copy of approved sale order to the sale department, because he will notify, he will acknowledge to the customer that your order has been received and we are in the process to deliver the goods. So here we go. What is the embedded control here? Obviously, so customer would expect that he would receive goods, right or wrong? Which goods? Which are approved by which are acknowledged by the sale department. Understood? There will not be a change in goods. Then here guys, we have here second department. Now we are talking about warehouse, because here this point is relevant to the warehouse. Obviously, in warehouse, we know their goods are placed in the warehouse. So that is why once the warehouse department will receive the approved sale order, right, which was sent by the credit department. So the warehouse department will pull the merchandise. Pull the merchandise means he will collect those goods which are approved from the warehouse. Prepares a packing slip. Please remember, packing slip is produced by warehouse department, like which goods are being packed. So that is why warehouse will pull the merchandise, prepare a packing slip, and forward both to the shipping. What both? Actually, the warehouse will send the goods along with the packing slip. Both. They will send it to the shipping department. You know, at start, shipping department also received the approved sale order from the credit department. Now we are with the shipping department. Shipping department will verify these goods and packing slip with the approved sale order, which they have received from the credit department, and the shipping department will prepare a bill of lading. Obviously, guys, when you dispatch the goods, so we also need to prepare bill of lading and send the shipment to the customer. Shipping department, what he will do? He will compare the packing slip which is produced by warehouse and the goods obviously which is pulled by warehouse. They will compare the packing slip and goods with the approved sale order, and shipping department will produce which document? Bill of lading, and send the shipment to the customer. Here what is the control? Obviously shipping department is trying to ensure that correct goods are shipped, because he's comparing what bill he's comparing packing slip, goods with the approved sale order. So that is why he's trying to ensure that the correct goods are being shipped. Now, shipping department forwards the packing slip, because packing slip is prepared by warehouse, right? And bill of lading is prepared by the shipping department. So now the shipping department, because shipping department has sent the goods to the customer, now shipping department will forward packing slip which is produced by the warehouse, and the bill of lading which is produced by the shipping department itself. They will send the packing slip and bill of lading to inventory control and to the billing department. Here we are sending, shipping department sending one copies of packing slip and bill of lading to inventory control, and one set of copies to the billing department. Now, do you remember inventory control also at the start they also received the approved sale order? You can see here inventory control, they received the approved sale order. Here you can see. Okay, now inventory control also received bill of lading and packing slip. So what they will do now, inventory control will compare packing slip, bill of lading with the approved sale orders and update the inventory system. Inventory system obviously guys, where we are where we are recording inventory, how much inventory is moved, right, from the system. So you need to move it right around, and this will be recorded in general ledger files also, right? Then what is the embedded control here? Obviously we are ensuring that as per the approved sale orders, goods are moved from the system also. Okay, then we are again with the billing department. You know, if you remember, billing department, they also received a one copy here, one copy of approved sale orders. Billing department also received. Now we are with the billing. Okay, because sale department is done, warehouse is done, shipping is done. Now we are with the billing. Inventory control is also done. So now we are with the billing department. So billing department, what they will do? Do you remember here also? Shipping department forwards the packing slip and bill of lading to the billing department. And billing department also received the approved sale order. So now what billing department will do? Now we are with the billing department. So billing department, what they will do? Billing department matches them. What they are matching? They are matching packing slip and bill of lading with the approved sale order. And after the matching, they will prepare an invoice. They will prepare an invoice. Understood? If invoice is a paper-based, so remittance advice is also included. Like how do you want a payment? You want a payment through check or cash. Nowadays, it's a system-generated invoice. Automatically, bank detail is available on the invoice. Understood? So, but they will compare. The billing department will compare packing slip, which is produced by warehouse, bill of lading, which is produced by shipping, with the approved sale order, which is approved by the credit department, and then they will create the invoice. Understood? I hope so it is clear. Then sale department, you know, at start, sale department has received the order, and sale department also acknowledged to the customer. Sales receives an invoice, because one copy of invoice which is produced by the billing department, it will send to the sale. One copy will be sent to the receivable department of the invoice. Sale department receive the invoice from the billing and update the sale order file. Obviously, in sale order, they have first purchase order they received from the customer, then they have created sale order, then they have a approved sale order from the credit department, right? So, and now they will also tag the invoice for their record. Now we are with the account receivables. Account receivables receives the invoice from billing and post a journal entry to the AR file. AR file means account receivable. For example, if Mr. A is your customer, obviously you have to book Mr. A as a receivable debit and you have to book the sale as a credit in his ledger account, right or wrong? Then we are with the account receivables. Obviously, when we put into the customer account, we are trying to ensure that customer accounts are kept current, like it is updated. Now, the last point, account receivables prepares a summary of all invoices. For example, there are 10 invoices created by billing department and 10 invoices are received by the account receivable department. Obviously, account receivable department will record in the individual ledgers, customer ledgers. For example, Mr. A sale is $100, Mr. B sale is $200, Mr. C sale is $300. Then all the total, they will send the total, the summary of all invoices. The account receivable department will send to the general ledger. General ledger means where one entry will be posted: debit account receivables, credit what? Sales. Okay, they will post the total into the GL file. GL means a general ledger file. So these are the stages, right? It means there are two ledgers are there: account receivable file and general ledger. Account receivable means say for each customer we will create a separate ledger, but the total of whole day we will post in the general ledger. I hope so it is clear. So these individual ledgers and general ledgers are also periodically reconciled, right or wrong? We match the total of general ledger with the total of individual ledgers, right or wrong? We do the receivable reconciliation also. I hope it is clear. So this was all about sales receivable cycle. Now, guys, we are going to talk about second cycle, and this cycle is called cash receipt cycle. Obviously, when you make the sales on credit, obviously in future, so you have to collect the money from the customer, right? So here we go. Let's have a look. First of all, what are the activities, guys? Please remember. So there are a few steps are there you need to understand. So it's starting with the first activity. It's called a mail room first. Let me give you idea about the mail room. Mail room means obviously mail doesn't mean email here. Okay, mail means like envelope. Sometimes just assume if you will think like few years back, maybe customers they were sending the checks through the maybe mail through envelope, right or wrong? So which department will receive those envelope or those checks? So that is called mail room. So they are saying mail room opens customer mail. Okay, two clerks are present at all times. It is a standard cycle. They're saying there must be two people. Customers' checks are immediately endorsed for deposit only, because in the envelope, if there is a check, so you will take it out, that check, and you will write on the backside of the check with maybe with the lead pencil for deposit only. And remittance advice are separated, because remittance advice we mostly send with the invoice to the customer. So once customer will issue the check against that invoice, so he will take the copy of remittance advice which was sent by you and the check, both they will send it to you. Now you open the envelope, in envelope you found two things: check and remittance advice. For the on the check, mail room will write it is for deposit only, and remittance advice they will separate it from the check. Now mail room prepares a remittance listing. You can say it is like a track record. You can prepare on the Excel sheet, like how many checks you have received in a day, what are the check numbers, what is the name of the bank, what is the name of customer who issued that check. So this file you can create. So mail room prepares a remittance listing of all checks received during the day. They will list it out, they will prepare the list of the checks they have received and forward it with the checks, like this list and the checks, they will send it to the cash receipt department. Understood? So remittance listing provides actually control total for the later reconciliation, because there is a total amount is listed on that sheet. So you can use it for reconciliation purpose also for later. And why here we have a two employees? Because it will reduce the risk of misuse of the asset, which is called misappropriation. Understood? If there is a one person, he can do some fraud also. He can commit. Now, point number 3, cash receipt. Because now checks and the remittance list is with the cash receipt department. Cash receipt department prepares a deposit slip because you have to deposit into the bank. Now it's a different system. We may directly go to the ATM machine and we can deposit the check and we can get the deposit list, deposit valid deposit slip, right? We can get. So, but if you will think about that, so we prepare a deposit slip and deposit checks in the bank. Obviously, we will deposit check in the bank. Bank will validate deposit slip, like bank will stamp that slip, right? Because in proper system, there must be a deposit slip for the record purpose. In small companies, you can receive the check and directly deposit into the ATM machine. Then, upon receipts of the validated deposit slip, which is validated by the bank, cash receipts department post a journal entry to the cash receipt journal. Obviously, they will write how much cash they have received. Mail room, because initially mail room received the checks, they prepare the remittance listing also, the list of the checks they have received. Mail room also sent the remittance listing to the general ledger for posting of the total to the GL file. Okay, the total of collection will be posted to the cash general ledger. Then mail room also sends remittance at listing and remittance advice to the account receivable department for updating of the customer account. Obviously, in the list, it is written which customer has paid how much money. So obviously, account receivable department will take the total, will take the amount from the list and will post the entry into the customer account. Then account receivables periodically obviously sends account statements. There is always supplier statements are there. Maybe you have received so many times, because here, for example, if we are a customer, so we will receive from the seller. If we are a seller, we will issue the supplier statement, right? To the customers, we will send the periodically statements to the customers showing all sales and payments activity. Obviously, if customer will disagree with your record, so he can contact you and you can resolve any discrepancies, right? So this is what is the point here. So these are the stages that are there. Understood? I hope so it is clear. So please, can you confirm through the chat option what is the purpose here when you send the supplier statements? Obviously, customer will complain about mistaken billings or missing payments. Obviously, because customer is also creating payable ledger, you have a receivable ledger, customer can reconcile, right? So reconciliation they can do if there is anything missing or overwritten or underwritten, so you can consult with each other. So this is what is called cash receipt cycle. Now we have a third cycle, guys. This cycle is called purchases payable cycle. Now assume here you are going to be a customer, right? Being a customer in your company, what process you will follow. So this is what we are going to discuss. Okay. So we have here again column for the business activities. It's written step by step, and we have an embedded control here. Obviously, if you will understand this column, this will be very easy for you. Like why we are doing this. So we have a first step. What is step number 1? Inventory control prepares a purchase or requisition when inventory approaches to the reorder point and send it to the purchasing department and to the accounts payable department. Let me guys first tell you basic background of this. Guys, for example, if you are working in a production department, you want production department, I'm saying, you want to produce certain units. Obviously, to produce certain product, you need material for that. So obviously, you will request the inventory department, inventory controller to release that material. And now inventory controller obviously will check in his stock that material is available or not available. Obviously, if that material is not available, then they need to buy. So that is why process starts from here. Inventory prepares a purchase requisition, request to purchase. Okay, obviously when inventory approaches to the reorder point or when inventory is less there. Okay, so inventory control will prepare purchase requisition and they will send it to the purchasing department. Okay, because purchasing department is responsible to buy those goods, and to the accounts payable because they are responsible to make payments. They are responsible to record that amounts in the supplier ledger. Understood? So that is why here purchase requisition is produced by inventory control and sent it to the purchasing and accounts payable department. Understood? Why we send obviously to the purchase department? Because they are responsible. So now here we go. Purchasing. Purchasing means a purchasing department. They will locate authorized vendor. According to the material, they will check who is the authorized vendor in their list. Okay. They will check the vendor in the vendor file. Prepares a purchase order. Who will prepare purchase order? Purchasing department. And update the purchase order file. It doesn't mean they will prepare the purchase order file and they will prepare a purchase order and keep it with them. No, obviously they will send it to the approved supplier also. Now, this is what is the next stage. Purchasing sends the purchase order, which is produced by the purchasing department. They will send it to the vendor. They will also send one copy to the receiving department because the receiving department, they should be ready to receive those products which they are going to order. And obviously, when we send a copy to the receiving department, so that copy should be blank. Means don't mention the quantity on that, how much quantity you have ordered. Why? Because if receiving department will receive more than what you have ordered, they will hide it. Right or wrong? They can steal the thing. So that is why when we send any purchase order to the receiving department, please make sure you should send it blank copy. So what they have received, they should write by their name. Because when they are not sure what they are receiving, they will write everything. Okay, otherwise, if they will receive extra thing, they will hide it. So that is why purchasing sends the purchase order to vendor, to receiving department, and to the accounts payable department. So it's written here, receiving's copy has blank quantity. Okay. Then guys, step number 4, we are with the accounts payable. Because accounts payable department received the first, what they have received, first they received the purchase requisition. Now they also received the purchase order. Purchase requisition was produced by inventory controller and purchase order is produced by purchasing department. Now accounts payable prepares a summary of all the purchase orders issued that day. Obviously, they will prepare a summary and forward it. This summary they will forward to general ledger for the posting of the total to the GL file. Okay. It's not only you will record in the GL file. So accounts payable will also receive a record in the supplier ledger, individual ledger as well. Okay, so why we are recording in accounts payable also in general ledger for the purpose of periodically reconciliation, because periodically we can reconcile our individual supplier accounts with the general ledger. So goods arrive at receiving. Obviously, because the receiving also received a blank copy of purchase order. So now let's assume goods has arrived at receiving department with the packing slip. Obviously, packing slip is sent by the supplier, not by you. Understood? Do you remember? Because quantities are blank on the receiving copy of purchase order. So now employees cannot assume the order is correct as received and must count items, and they will record whatever they have received it. So they cannot hide anything. Now receiving prepares a receiving report, because once goods will arrive at receiving department, so they will prepare a receiving report and forward it with the goods. It means they will send receiving report, copy of receiving report and goods to the warehouse, because goods need to be placed in the warehouse where inventory controller is sitting. Now warehouse verifies that good received, whatever goods they have received from the receiving department. Okay, they will compare, match those listed on the receiving report. Obviously, when you receive the goods, and you also receive the list with that. So you will compare the goods with the list, right or wrong? This is what the warehouse will do. Then obviously why we do this is important, but when we compare the goods with the receiving report, so it will help you to detect any loss or damage between receiving and warehouse. Okay. Then guys, here we have here point number 8 again, receiving, because receiving prepared a receiving report. This receiving report was sent to the warehouse also. It is also sent, okay, to inventory control department also. Now this is what we are discussing. Receiving sends receiving report and packing slip which was produced by your seller. Packing slip is produced by your seller, right? Receiving report is produced by receiving department. So they will send these two things to the inventory controller. Do you know inventory controller is the first department who has created, who generated the purchase requisition. So that is why now inventory controller will compare the receiving report, packing slip with the purchase requisition and update the inventory records. Understood? I hope so it is clear. So they are doing this for the reconciliation purpose to cross check simply, you can see. Now, again, receiving also sends a receiving report. Now remember, receiving department has sent the receiving report to the warehouse. Receiving department also sent the receiving report to the inventory controller. Now receiving department also sent the receiving report to the accounts payable. And accounts payable will match this receiving report with the purchase requisition and with the purchase order. Because purchase requisition is produced by inventory controller, purchase order is produced by purchasing department, receiving report is generated by receiving department, so they will match. Now accounts payable department will match all these things and they will record in AP files. Understood? Obviously, this will also be posted to the general ledger files. I hope it is clear. So this is what is the cycle for purchase cycle. So you can go through. Please confirm, is that clear? Now, guys, we are going to discuss about what? We are going to discuss the fourth cycle that is called cash disbursement cycle. Understood? So obviously, cash disbursement means to say when you purchase the goods on credit, obviously you have to make the payments, and your supplier will also send you the invoice, right or wrong? Your supplier is responsible. Do you remember the sale receivable cycle? As a supplier, your supplier will send you the invoice with the remittance advice. Now you are a customer, you have to make payments against that invoice. So that is why this process will start from here. Purchasing. Purchasing means a purchasing department receives a vendor invoice and remittance advice. The remittance advice is separated and filed in purchasing department. Like you received a, nowadays it's not a case, nowadays you are receiving only one invoice where account number is also mentioned, bank account detail is mentioned, but assume if you have two things, one is remittance advice, one is vendor invoice, so you will separate as a purchasing department. The invoice is matched with the purchase order. Obviously you will cross check this invoice is for the same goods which we have ordered, and you will approve for the payment. You are going to approve that invoice. Please remember, remittance advice is with the purchasing. Only vendor invoice you have checked and you have approved it for the payment. And the purchase order is marked as closed because in purchase order you already have purchase requisition, you have a purchase order, now you receive the invoice also, etc. And the approved invoice which you have approved, you will forward to the accounts payable department. Now the accounts payable department will match the approved vendor invoice with the AP files. You know already accounts payable department have purchase requisition. Accounts payable also has purchase order. Accounts payable also now receive the approved sale, approved purchase invoice. You know, for you it is purchase invoice. For the seller it is sale invoice. So they will compare with the AP file, okay, and issues a payment voucher. Payment voucher, I hope so you know. It's accounting terms. So it is like a request to release the payments. to the cash disbursement department. Who will issue the payment voucher? Accounts payable department, don't forget. Okay, and here what is the control? This you can just go through. Ensures that invoice is for goods actually received, that duplicate payments cannot be made. Okay, then what we have? Upon receipt of the payment voucher, because payment voucher was sent to the cash disbursement department. Once cash disbursement department will receive the payment voucher, they will compare with the approved vendor invoice. Okay, cash disbursement issues a check and forward it to the purchasing. The check will be sent it back to the purchasing. Purchasing department at start, they separated the remittance advice in the step number 1 of this cycle. Now purchasing sends the remittance advice and the check to the vendor. Understood? Now the next stage, cash disbursement prepares a check register, like it is their record, how many checks they have issued, to whom they have issued, what is the amount of each check. So they are recording, obviously. So cash disbursements prepare a check register of all checks issued during the day and post a journal entry to the cash disbursement journal, like they will record the payments. The check register is also forwarded to general ledger for the posting of the total payments will be posted to the GL file. Understood? And obviously it will be recorded under accounts payable file also. And that then on the end of the period they will do reconciliation. I hope so it is clear. So now we are going to discuss the last cycle, which is payroll cycle. Now guys, we are discussing now payroll cycle. Okay, so here we go. Number 1 here, guys. Please remember, business activities are there. We are going to discuss here this column. Okay, it's just assume first of all. Let's assume you want to make the payment of salary. Obviously, salaries are prepared by the payroll department. Mostly in small companies, salaries are prepared by accounts department or HR department. But in large companies, we have a separate payroll department. So this is what we are going to discuss. So that is why first it will start with the human resource. Human resource department will send a list of authorized employees with pay rates and deductions to the payroll. The reason is that because whenever you need any leave, medical leave or normal leave or annual leave, so you always, do some arrangements with the HR department. So that is why HR department always have your record, right or wrong. So that is why it's starting with the HR department. HR department will send the list of authorized employees with their pay rates, with their any deductions to the payroll. They will send it to the payroll department, like HR will send it to the payroll. Now, employees, the register. Let's assume if you are a manufacturing business, right? So once you will go to the production area, so there maybe, or once you will enter to the factory, maybe there will be a system for you where you have to write your in and out time. It could be a biometric system also. So this is what is that step. Employees register the start and the end times of their work days on the clock cards. So mostly it is done in the timekeeping department, right? So you will write your in and out time on the clock card. So you can assume clock card is a document where you will write your overall time in and time out. Understood? So then we have our employees. Again, record time worked on various tasks on job time tickets. So let me tell you, let me explain the difference between clock card and the job time tickets. For example, I entered into the factory. So I entered at 9 a.m. I left at 5 p.m. So with this 9 a.m. and 5 p.m. where I will record in the clock card. Now, once I enter to the factory, now I move into the production area where I will work. Let's assume I am a mason, a furniture maker. So I can, wood maker, you can say. Okay. For example, I can make chairs, tables. Now, chair is a separate product, table is a separate product. I can also make the bed. So 2 hours of a day I spent on the chairs, 2 hours of a day I spent on the tables, 1 hour I spent on the bed. Understood? Now these are called three jobs. Chair is a one job, bed is a second job, and what was that? Table is the third job. Now, how much I have worked on each job, this will be recorded where? This will be recorded on jobs time ticket. Understood? Because this job time tickets later on we will send it to the costing department because they want to record the cost of the chair, labor cost of the chair, labor cost of the table, labor cost of the product. So this is what, that's why they're written. So employees record time worked on various jobs on the job time tickets. Then point number 4, at the end of the pay period, once period, it could be weekly, monthly. This is not our debate. A production supervisor approves the clock card and job time tickets. Who will approve? Production supervisor. And forward them to the timekeeping department. Okay, timekeeping reconcile clock cards and job time tickets. Understood? They will do reconciliation. Timekeeping prepares a summary of hours worked by job, like how many hours of labor they have worked on the chairs, how many labor hours they have worked on the table, how many labor hours they have worked on the bed. So timekeeping prepares a summary of hours worked by job and forward it to the cost accounting department, because cost accounting department, they have to record the labor cost for the in the job order costing, right? Or for the cost of the product, they have to record it. Now, timekeeping prepares a summary of hours worked by employee and forward it to the payroll also. They will send it to the payroll. So payroll will match it with the authorized employees list, because authorized employee list was created by HR department. Now payroll will match the employees and the employee rate with the authorized list, and payroll department will prepare a payroll register and update the payroll record. Payroll register, you can say salary they will prepare, right? Accounts payable receives the payroll register. Payroll register is prepared by the payroll department. Now they send it to the accounts payable. Now accounts payable, once they will receive the payroll register from the payroll, they will prepare a payment voucher and forward it along with the payroll register, like this voucher and the payroll register copy. They will send it to the cash disbursement department, because cash disbursement department, they has to start transferring the salaries, obviously. Now accounts payable also forward the payroll register to the general ledger for posting of the total, the GL file, because they have to record the salary or wages expenses. Understood? Cash disbursement compares the payment voucher with the payroll register. Once they will compare, I'll take your question, don't worry. Cash disbursement compares the payment voucher with the payroll register with the total, okay, total of the payroll register, and initiate appropriate bank transfer. Understood? Now this you don't need to know how many types of transfers are there. It depends, country to country. In UAE, you may give salaries through the checks. You may give the salary to the wage protection system, WPS system. So that is why simply have to remember cash disbursement will execute the bank transfers. Okay. Now the employees paid by manual checks, like if any employee is paid by check, so check are given checks by treasury personnel. Even, okay, check is prepared by cash disbursement department, but it should not be, this is the question in the exam. So cash checks are issued by the cash disbursement department, but it should be handed over to the treasury, it's a finance department, and finance department should distribute these checks. And it should not be distributed by payroll and their supervisors department. It should not be distributed by payroll. Okay, I hope it is clear.